Okay, doing a little bit of a dive into amortization schedules and some thoughts about effective interest rate compared to actual interest rate. And then in terms of why I'm looking at the amortization schedule and the scenario I'm using a client that's doing a refinance right now. And this is the methodology we walked through to kind of look at, is it worth it to do a refi? What are my options? And I think just understanding the amortization schedule from the beginning in terms of buying a house, refinancing, whenever you're doing anything related to debt, looking at the actual schedule, I think can be a little bit like eye-opening, particularly if you compare making extra payments or a 15 year compared to a 20, compared to a 30, how quickly am I going to be out of debt, right? Like really looking at it beyond just payment and interest and into actual costs can help just round the curve in terms of making decisions, right? So let's dive right in. So this is the client's current loan. He's about 3 years in or 2.5 years into a 30 year. He's at 7.375. This is his current payment, principal, interest, mortgage insurance. That's the current balance now, right? Let's scroll down to the bottom. Let's take a peek. And once he gets to the finish line, he's got 329 payments left. He'll pay a total of 912, right? Which that's a total of principal and a total of interest. And in terms of the breakdown there, let's look at the principal paid. I'll do that math with you just so you can kind of see that it's a big number that's mostly interest, right? So if you look there, you're paying mostly interest, and then there's going to be some mortgage insurance. Bump that in there too, right? 30 grand in mortgage insurance left, 504, 378, 912. So that's that total, all of it going into there, right? So that's just staying the schedule. Now, the conversation I have with this client is, I'm not sure if I should do it. What if I wait, just stay where I am? I don't know if the payment difference is worth it, right? And then we ran the numbers of a new 30 year, got him a rate of 6.125. The new payment, no mortgage insurance because he has enough value now in the house to drop that completely with the new refi. Because the thought was, oh no, I'm going to a new 30 year. I don't want to have to keep resetting the clock. And I said, I'm completely with you on that. And what we should look at is what you're going to owe in the future in the short term, right? And you can see that here in the balance. And then the next, this is how you break it down from a break even perspective. In the next 36 months, right? So 36 months from now, he owes 364 here. In month 36 of this new one, he owes 370. So I'm talking with him. I'm like, yeah, it makes sense. You're going to owe more starting off. Now, the way to really view a 30 year to a new 30 year and you're extending term and you don't do anything different is the tortoise and the hare, right? You're in a current loan now with 27 years left. You're thinking of refinancing, but you're fearful of, oh no, I'm kicking the bucket down the road of another 30 years, which is completely, you want to think about that, right? If that makes sense. Does this match my life, my goals, all of that? You're going to not break even pretty quickly, but eventually the tortoise and the hare race, eventually, even if you don't do anything different, the fact that you're getting into the new mortgage, the new interest rate with the lesser payment, even if you go all the way to term of a 30 year, you're still going to save a good amount of money. Eventually, this loan beats the other loan, even if you pay for an extra 2.5 years, right? So eventually it's still going to be better compared to what he has left to pay, because this is what he has left to pay, right? This isn't inclusive of what he's already paid in, because you don't want to do that math. That can really get you, caught in a quagmire. You want to look at what you have left to pay for debt and what you're willing to take on for risk, because yes, pretty quickly he's going to owe more in the short run, but eventually he's going to catch up because of that interest rate, and he's still saving about $600 a month, right? So 2339 compared to 2683, right? A principal and interest, but during the mortgage insurance period, it's 2933 is what he's paying in principal, interest, and mortgage insurance currently. And the new one would be 2339, right? Now, where it really becomes powerful is, what does it look like for people that want to say, well, I don't want to pay all that interest. I don't want to do a 15 year because I want flexibility. If you take the 30 year and make some extra payments. So here's the refinance scenario, 6.125, there's the payment, right? No mortgage insurance again. All the same numbers down here at the bottom as over here, right? So you got 842,149, 842,149. Now, here's where the math really came home for this client, right? So he was like, I'm really fearful of kicking. I don't want to keep kicking the can down the road, right? So, well, if you don't refinance, this is your payment. You do nothing. If you decide to do nothing, you still have the house. You're not wrong for doing it because you're worried about the timing, right? This is your payment either way. So what if you refinanced and you kept this as your payment and we did a reduction of principal every month of about $600, right? And I know the math's not perfect because eventually this mortgage insurance does falls off at about month 120, right? But bear with me because this is what he'd be doing for the next 120 months if he does nothing. His mortgage insurance is hard to get off of there. You can get it off early if values increase, but now you're paying for an appraisal. You might as well look at the window to say, like, can I refi? I'm gonna pay for an appraisal and a refi anyway. I can't get the mortgage insurance off early without getting an appraisal done. I need, it's worth it to look at it. Now let's look at it if we compound the payment. So if you make a principal and interest payment of 29.39, which would be your regular principal and interest of this, and then a principal reduction of 600, right? It's going to reduce the principal faster, right? Look at the principal going way quicker over here, right? Interest is about the same. It stays the same, but starts to get better, right? You can see over here it's starting to balance out that way. That makes sense. The balance is going down faster, right? So this was the new 30 year, right? So you got 360 months. Over here, keeping to the same schedule, this person is going to be out of a mortgage payment in month 217. So just about 18 years compared to staying in it for 360, compared to staying in it for another 349, I think is what was over here, 329. So 217. Look at the principal and interest, or look at the total. That's the total paid. $200,000 cheaper than the refinance of doing nothing. Now that doesn't take into account the benefit that he's getting a $600 swing in his expenses going out monthly, and that doesn't take into account opportunity costs on what you could do with that 600. Right? Is that getting invested somewhere else? Whatever you're doing with it. So just doing math in a vacuum of if you're in a current payment of $29.39 and you don't refinance, you don't have that $600 savings. So, let's forget about what you're going to do with it. Let's do the math on if you do refi and you keep making the same mortgage payment, how much more less interest would you pay over it? And it's 252 compared to 504. You're going to cut your interest in half, not including the mortgage insurance. Add the mortgage insurance and it's in half plus some, right? You're cutting it in half by not doing much different than changing the debt structure that you're in, but then not changing your cash flow expenses because it's still all going right back into the mortgage. And then the fear is, well, what if rates get lower again? I need to refinance. Well, keep making the $2,900 payment. And if rates go to 5.125 and you're nervous about refinancing it to another 30 year again, valid. But again, it just turns into the same compound math. So as debts and terms get better, right? And if you keep your payment going out, you'll just compound that benefit over time and you'll own your house faster and you'll pay a way less amount in actual effective interest, right? Again, you can go right to here and say, you know what, I'd rather have the savings. I'd rather have the $600 a month. I'm gonna give it to my financial advisor. I'm gonna use that to invest in my kids' college, right? I can't quantify all of that. I can only do this math in a vacuum. I'm not a financial advisor. I can't bring you down that road. I can hint towards it to tell you it's a good idea to have that conversation, right? To figure out, maybe there's middle ground. Maybe there's 300 towards investment, 300 towards the mortgage, happy medium, right? Maybe it's something in the middle, right? So planning your mortgage math based on your life and your financial goals is a crucial element to actually determining if refinancing makes sense and or even just buying the house to begin with, right? And how to structure the debt. Everyone starts with interest rate. Everyone starts with closing cost terms. Those all matter. These are the conversations to me that I think become life-changing. So I wanted to show what it looks like to really look at an amortization schedule and go a little bit further and beyond a rate quote or a quote sheet, if you will, and get deeper into the actual numbers to help, just see what it really looks like. Because on a 30-year, you're not paying a lot of principal at the beginning, right? It's mostly interest. You don't catch up until over halfway through, right? It takes a while for that to catch up to that you're paying more principal than interest. But if you make principal reduction payments, even here, even if someone's like, you know what, this is the best my rate's going to get, because let's say rates don't get better, but I have some extra income, I'm going to make extra payments. It doesn't take much to start chipping away an extra 100, $200 a month. All of a sudden, you're starting to flip that math of principal and interest on its head a little bit because you don't have to pay what the actual interest is that you signed up for. It's the beauty of a 30-year fixed in America. There's no prepayment penalties for pretty much any primary residence for the house you're living in, right? So you want to make some extra payments? Make some extra payments. It's going to change the interest. This number is fungible, right? The principal, not so much. What you owe is what you owe. The interest is fungible based on do you make any extra principal payments? Because your starting rate isn't the total rate that you pay, right? Because you can see here, 378 principal left, 504 in interest. That's not 7.375%. That number is a yearly number. So that number is fungible as your term goes on based on you paying down principal, right? So you can impact your actual effective rate and own your home faster than what you actually sign up for. So that's something I always go over with clients when they're refinancing, buying a house. The 15-year is good. The 20-year is good if you're trying to accomplish this. If you're trying to say, I want to own my house faster. The 30-year is good if you want some flexibility and want to pick and choose how you can plan your mortgage around your finances, right? Maybe you're commission based and you like the idea of having the ability to make lesser payments if you need to. And then if times are good, you want to make some extra payments, go for it, right? Or you're self-employed, you're seasonal, right? You get bonuses throughout the year, whatever it is, it's just good to know that you have some options there. And this is what you should really be looking at.